Hello, everyone. Welcome to the newsletter for December 20th. Approaching the back end of the year, if you can believe it. So we've had a fairly substantial news week. Actually, there's been a lot going on in the crypto space it's not anything that's been too unexpected, but we're certainly starting to get some clarity, particularly around regulation. So there was obviously a note by the Treasury, the US Treasury, that was trying to look at how we're going to, how they're looking to treat self-custody wallets and KYC and things like that. We've got a few new players on the block, a couple of insurance funds who are now stepping in and actually putting BTC on their balance sheets. We've got things like Coinbase's IPO. So there's a lot of movement going on in ultimately it's signaling a maturation of these markets. And we're starting to get a little bit more clarity on these regulatory side of things. And what I wanted to do is just kind of discuss at least my best understanding of them. And again, they're all a bit of a dark art to understand, what regulators and things are doing. And we certainly have to lean on many of the attorneys and the lawyers who are in the space. And, thankfully, there are very many people who are incentivized and well equipped to actually be pushing forward the answers to these things. And at the moment, we don't have exact guide. It's more guidance rather than a policy at this point in time. But the industry is full of people who are well and truly incentivized to be trying to steer the correct course. So it's one of the very, very fortunate things about this industry is that not only do we have very, very smart people and a collective of very intelligent and well-meaning people building this industry, but the reality of it being a financial market is that many of them have made substantial sums of money, and when you've made substantial sums of money, you can fund these types of pushbacks, and second of all, you are financially incentivized to make sure that things go the correct direction. So we're in this phase of we've got a few regulatory updates, and the markets are starting to really look a lot more mature. And I should probably preface that the markets being, Bitcoin and maybe Ethereum, but predominantly Bitcoin in this instance. So we'll just talk through a few of those things, and then we'll close out with a couple of podcast recommendations, and then we'll move on and do a quick on-chain update and just see what some of the, some of the charts are doing now that we've got a fairly substantial, it's almost a $5,000 weekly candle to the upside. So we'll just have a look at some of the charts there and see what we can pick out of them. So it has been a busy week. FinCEN has launched their guidance. So it's not policy at this point in time. It's essentially, this is the statement of saying this is our proposal. This is what we are thinking of doing. So that's something that we'll go through. Germany has brought in an effective ban, so ban in inverted commas, an effective ban on derivatives. And we'll talk about this. There's a few different layers to this story, and they're all semi-interlinked. So as we go through these different items, you'll see how they're all stitched together. Coinbase has announced their IPO pretty much on the day the BTC breaks all-time high, which talk about exit liquidity. They could not have timed that better. MicroStrategy's at it again. They've done another it was supposed to be $450 million. Basically, it was a depositor's note. So the idea is that you would, it's a bond, more or less. So they were going to issue a bond at 0.75% interest, and they were going to use the proceeds to buy Bitcoin with it. And essentially, they're a convertible note, so people can then convert that into stock at a particular price. So it acts somewhat as an option or a warrant is probably a better term. It's essentially it's a convertible bond that can be transferred into MicroStrategy stock at a specific strike price. So that was supposed to be $450 million, and it was oversubscribed. I think they made $650 million. So the $650 million from MicroStrategy, again, sitting somewhere in the buy support realm. And as some of you may have known, actually MicroStrategy used Coinbase as their agent to actually purchase their coin. So, again, there's lots of things kind of lining up on that front. And what we are going to cover, so we won't touch MicroStrategy because it's more or less old news at this point, but Mass Mutual Insurance, which is a Massachusetts insurance fund which has been around for 169 years, has decided to invest $100 million and then $5 million in a periphery investment fund. So, big insurance firms, $260 billion under management, they are now moving some of their balance into BTC. I mean, this is really starting to become big dogs, right? These are very, very large players entering the market, and they're entering with size. although not size compared to their balance sheets, but certainly size compared to the the paychecks you and I would be playing around with. And what this really looks like is where we've heard that, it's a manipulated, it's a Ponzi scheme market, we're starting to see it as a maturing market. We're seeing far bigger players, far more influential players, and starting to hit the point, and this is very interesting because we're talking about regulation here, we're hitting the point where so many major institutions are now involved that it's becoming almost politically untenable for there to be an outright ban. I think the risk of that kind of thing is actually quite rapidly deteriorating, because once you have insurance companies who are investing their balance sheet into it, publicly listed companies with it on their balance sheet, we're really starting to talk about a very, very politically challenging, plus you've got high net worth individuals, right? You're talking about a lot of people with a lot of money. And I think the risk of an outright ban, at least in the West, is now rapidly deteriorating. So there's that side of it. That's a plus, that's a positive. Now, the balance of that is they may not be able to ban it, but they can certainly still try to control it. And that's what we're going to talk about first, particularly around this FinCEN guidance. So Jake Chavinsky's put out some excellent tweets. So I put this in the Omnia chat room. I would highly recommend reading it. Read it twice just to understand what he's saying. He does a very good job of actually explaining these things, and he's one of the guys who's more or less on the front lines of trying to steer things in the right direction and really putting the thought in behind where this all needs to go, and what he thinks is the ideal outcome versus what is actually in the proposal. So what they've essentially put forward is saying that for deposits and withdrawals greater than $3,000, so $3,000 worth, that involves what's called a non-custodial wallet. They're trying to get language around non-custodial, unhosted, self-hosted. There's all these terminology, which I think is all part of the game. But ultimately, a wallet that's not an exchange, right? So they've got a few terms here: a VASP, or what is it? Virtual asset service provider. That's essentially any exchange, money provider, think centralized entity that you would interact with. And anything that is yourself, if you are depositing or withdrawing to, the proposal would be that if it's greater than $3,000, you would essentially need to record the name and physical address of the wallet. It's essentially KYC the address. Now, the challenge with this type of thing is it's essentially trying to extend KYC AML into the actual wallets themselves. Now, the challenge with all of this is obviously they have to collect a large amount of data to do this. And if you're an exchange and you've been given guidance to say, hey, you need to KYC every single withdrawal over a certain amount, and we all know that this will start at 3,000, but these things tend to creep, and they tend to creep in the wrong direction. It's unlikely it's going to go from 3,000 to 20,000. It's more likely to go from 3,000 to 200. You know what I mean? So it's more likely this will get more onerous with time should this actually go in and become policy. So the first issue is that they're now starting to collect huge amounts of data. And for those of you who saw, there's actually a data breach, not only of Ledger, so Ledger, the hardware wallet, and people are, seeing scams show up left, right, and center. That's going to haunt the industry for the next couple of years. But we also saw that was it the Fed? I think it was the Fed. They actually got hacked, right? So they had a data breach a few weeks ago, or, fairly recently. So there's a data honeypot, and this is obviously financially sensitive data. I certainly don't want people knowing what my holdings are. I'm sure you don't want the same either. And combine that with the propensity for our data to end up on dark markets and email addresses to get spammed with things. I think this is important because the data honeypot problem is very real, and I think everybody should be conscious of using burner email addresses, perhaps email addresses that work for individual. Each exchange has its own address, so you can quarantine your own data. Make sure you're using things like two-factor authentication. Don't click on any links, because the risk is that there are now so many data honeypots, and it's so easy to fall into these traps. So, this is only, if this does end up going ahead, this is only going to amplify that type of problem. So, let alone it being a surveillance problem, it's also a data honeypot problem. But problem two on the right here is because the institution, so if you're Coinbase or you're Kraken, and this proposal does actually go in and become the way it needs to work, they've provided so little that there's a lack of clarity, and this is what Jake is trying to say, is that there's a lot of ambiguity in what they've tried to say. and what the actual rules are. And the challenge is that because it's very hard to determine as Coinbase, you don't want to break the law. You don't want to have any lawyers crawling around trying to find something that you did wrong. They are more likely to actually, just as a cost motive, just stop withdrawals as an example of behavior that they just want to stamp out, simply because they don't want to be breaking law accidentally. So, because of these laws being made and crafted, whether intentionally or not, in a very ambiguous way, it is more probable that exchanges will just stop the behavior altogether rather than actually have any risk whatsoever of something like this happening. So that's another risk, is this lack of clarity. Now, he talks about later on, again, I highly recommend you go and read this thread to get a little bit more insight. He also talks about many of the problems. So there's supposed to be like a 60-day comment window for the public, and they've only given 15 days. They've also done that over the holiday period. So there's lots of things that from a legal perspective, they're pushing back on. But in terms of, what I kind of wanted to bring to your front of mind is, first of all, start really considering your data, how you're actually signing up for exchanges, where is your data, have you siloed it, make sure you're aware that some of this could end up in dark webs. You could get sketchy emails and things like that. So just don't click links. Just be really, really conscious that this is this is the type of data that does end up in the wrong hands. And yeah, just be aware of this lack of clarity side of things, which is essentially a problem for the exchanges, but will become a problem for us. And my expectation is, should this actually end up getting implemented in the US, I would strongly suspect that much of the West would follow. So we already have these rules in Netherlands, France, and Switzerland, if I'm not mistaken. I think it would just continue to creep and expand throughout the West in particular. So again, this is not something that you and I can do very much about at all. We have to just be aware of it and just understand the rules in your jurisdiction, and just be conscious that this is the trend. In fact, in the very bottom here, this is what Jake says here. This is probably the most important point. Today's proposal follows a global trend of extending AML regulation to transactions from VASP to wallet, from exchange to your wallet. Yep. This is the trend. It's about the directionality of this thing. This is what we just need to be aware of and just conscious as we move forward. And on a similar kind of realm of regulations, Hasu talks about, and I know the UK has done something very similar. In Germany, they've basically brought in a rule, or they plan to bring in a rule in the new year, that essentially is that for any derivatives, so they're not going down the path of actually banning derivatives. I know the UK has banned derivatives, crypto derivatives, so contracts for difference and options and futures. So in the UK, you literally can't trade them. My understanding is that they're not banned if you use an overseas venue. It's only ones in the UK that specifically market to and service in the UK. So this is again one of those problems where regulators bring in a law and it just pushes people into sketchier and sketchier bucket shops to do the same trading. But this is another thing to be very, very conscious of. So what Hasu is saying here is that in Germany, they're not banning derivatives, but they're introducing extremely adverse tax conditions to effectively ban derivatives. So what he's saying here is that your losses are no longer deductible, right? Or they're deductible only to 20,000 euros. Now, the challenge, what he's saying here is that it doesn't refer to your net result. So if you win 100,000 in trades and you lose 80,000, technically you're up 20,000. Now, if that was spot, your taxable income would be 20,000 in this instance. What he's now saying is that for derivatives in particular, you have to pay the tax on the 100,000, and you can only discount the 20,000 of that. You can't discount the full 80 that you lost. So what can happen there is that even though your total net winnings is 80,000 euros, you actually have a tax debt applied to 80,000 euros, which more than likely will blow out your $20,000 profit. So it basically means that unless you're winning every trade, you could end up with a fairly substantial tax debt that well and truly exceeds your net position. So you can clearly see that this becomes an extremely challenging risk, and obviously crypto tax is hard at the best of times, but this is a mechanism that the regulators can actually use. If they don't like behavior, they make it so adverse to do it taxable, via tax laws, that it essentially becomes just a horrible, horrible experience and no one will do it, right? Now, the worst bit is that what he says on the bottom here, people are still actually allowed to trade these things and they can generate this tax debt. So there will be people who don't understand this and they are going to get hit with a a horrible tax debt at the end of this whole thing. And this happened to a lot of people in 2017, by the way. There's many stories of people who traded all their altcoins. They made a lot of money on ICOs, and then they held those ICOs all the way down to the bottom. So they made stacks of money. When they were at the top, they're swapping between coins, and every single one of those times they're generating a taxable event. And then all of their coins went to near zero, and they didn't sell them for fiat. So now you have a huge tax debt from 2017, and your assets that you would otherwise sell to pay that tax are worth zero, or next to nothing. So this is it's a mechanism by the regulators, but it's also something that everyone needs to be very just conscious and careful of. And again, I have no idea how tax systems work around the world. I find it confusing at the best of times. I'm certainly not qualified to give any advice in any way, but it's something just to be aware of, because these are the types of things that can get people into some seriously hot water. It's certainly, for me personally, it's one of the things that actually pushed me away from trading, is I just don't want to deal with this. Right, I'd rather just sit there and hang on to spot and realize it all at the end. So I think this is something to be very aware of. And again, this is part of a trend of tools that they're going to use to incrementally creep into this kind of thing. So again, just something to be aware of. And what's really interesting is so the Grayscale investment products are the biggest. I think, I don't know if they're publicly listed, but they're certainly accessible in certain brokerages. And, we're starting to transition here. So those first two are more on the regulatory front. This is just an interesting observation that I've seen talked about quite a bit, that there's this consistent premium. So we know that institutions and larger players are coming in, and that interest in these products is increasing. The types of institutions who are actually buying the Grayscale products in particular are mostly hedge funds. And what's really interesting is that they're taking advantage of this arbitrage opportunity. So because many people cannot access just spot BTC for whatever reason on institutions, or they need to be buying this product, we're seeing consistent premiums, 135% for BTC. At the moment, the premium is 300% on the ETH product. And this is just crazy, right? So the share price for Ethereum is $20 a share. I don't know why they're not 1 ETH to 1 ETH, and I feel like they made a huge mistake with that. But anyway, the actual ETH per share is $6 or $6.60, and they're trading at $20. So there's a huge premium in all of these things. Now, hedge funds who can use these products, so there's people who are buying this because that's the only way that they can get their institution exposure. So that's why there's a premium. You've then got hedge funds who are saying, hey, I can buy both spot and GBTC. I'm going to do the in-kind arbitrage trade. I'm going to buy BTC or ETH. I'm going to send it to Grayscale. I'm going to lock in the premium. And after the 6-month or 12-month lock-in period, I can then sell my shares. I assume that because this premium has been very, very consistent, I can essentially lock in 100 to 300% premium on these products. Now, what's really interesting is that GBTC has almost 5.5 million, 546 or 500,000 BTC, 2.6 of the 21 million supply. Ethereum, the ETH Trust, has 2.94 million coins, which is also surprisingly 2.6%. And this arbitrage opportunity is going to persist for some time, because there's no ETF, right? This is because we don't have an ETF. There's actually this disgusting premium that people are having to, or forced to, or whatever it is, to pay to get exposure to these assets in different investment vehicles. Now, the risk that I actually see in all of this is this arbitrage trade is more or less one way. In general, the coins are going to go in. So if you're a hedge fund, you're going to buy spot, you're going to send it in kind into Grayscale. Grayscale doesn't do withdrawals, right? There's no withdrawal feature from Grayscale. Once they go in, they don't come out. This is actually a huge sink for both Ethereum and Bitcoin, right? So these are products that are most likely going to turn into some kind of ETF down the line, but it is absorbing coins that don't come back out. So it is very interesting that you can see these premiums. There's a motivation there, right? People are going to take advantage of this spread. They are going to be capturing this 300% premium. I expect a lot of ETH to be flowing in. So that's, first of all, buy support, something to just be aware of, that there's probably going to be buy support for ETH while this premium exists, because who wouldn't want to capture 300%? but that's also going to put a huge amount of ETH in the hands of Grayscale. So, again, there's a layer of security to all of this and proof of stake. There's all these kind of things playing on, but this is certainly something to just be aware of, that clearly there's demand because there is a premium, but there's also a huge sink for coins, which longer term is probably not ideal. It's probably less critical for BTC, I think, than it is for Ethereum going proof of stake. But again, we'll see how this plays out. But it's certainly an interesting observation that this premium has more or less existed the whole time, and it's signaling that there is not enough products on regulated brokerages and things, and this is how early we really are. There's not enough products if someone is willing to pay a 300% premium in order to actually achieve this. I mean, apply a 300% premium, I think ETH will be well and truly above all-time high, $1,800 or something. So people are already buying ETH above all-time high, and BTC at 135% premium. So, in fact, the premium hasn't broken all-time high because it was even more insane back then as well. So stepping through these things, Coinbase IPO. So, they announced that they're going to go IPO as Bitcoin breaks through all-time high. So, happy days, right? This is a pretty spectacular maneuver. The market attention that this will actually bring, it just can't be understated. It is huge. It is really, really big news. It's going to bring a massive amount of exit liquidity. So just the amount of attention on Bitcoin right now is going to be only amplified as this IPO goes forward. I really actually like the take that Nick Carter had down here. So it will be a major exit for early employees. A lot of people are going to make a lot of money on this IPO, and many of them are actually going to go and have liquidity for angel investments and create their own startups, right? This is really cool. I like this take. This is actually, if you're an early employee at Coinbase, you're an early investor, you get massive exit liquidity because of the excitement in the market. People will just be buying this thing hand over fist. And you can then go and deploy. You can either go and retire, right? Happy days. Or you can actually go and redeploy that capital into new investments, right? And help build further infrastructure for the space. And it could be that you can actually do it. Some of these people will make so much money that they can go and fund non-profit type stuff, right? They don't care about the profit. They just want to build open source software. So some of this will play out, and we'll get more infrastructure, more companies. It's a really positive thing. So, ultimately, I think this is just overall good. It's going to bring more attention, number go up, happy days. And also, it's a level of legitimacy too, because being the biggest US exchange, just having that exposure, it's part of that. Markets aren't manipulated anymore; they're maturing. Even though markets are always manipulated when human beings are buying and selling. And I think, Mass Mutual. So Massachusetts Mutual, I think it's short for. So they've decided to put $100 million in Bitcoin, and they've put $5 million into a investment firm, right? So they're going to do their own infrastructure thing on the side, but $100 million. So this is a 169-year-old insurance company, and insurance companies have only one job, and that is to correctly price risk. So the fact that they're a really, really big asset manager who is now investing in BTC means that they have done their due diligence. They're willing to step in with, granted, $100 million out of a $235 billion portfolio, but their job is to assess risk, and this is confidence, right? This brings a huge amount of confidence to the next investor, and that's what it becomes. It ends up becoming a self-fulfilling prophecy. You start seeing all of your competitors, right? Companies are measured against their competitors. So now all the insurance companies are now looking at this and saying, well, what happens if they outperform us? We actually now have to step in and have our own exposure. So the snowball is rolling really, really hard. So, this to me is actually a really important step, because it's just another cog, but a whole new industry that's now stepping in, and that the insurance industry is just ginormous. So we're talking about a very, very old company. We're talking about very, very large buckets of money, and we're talking about confidence. And this is super bullish in my eyes. So, all in all, we're faced with two linked and competing and very interesting dynamics, to be honest. We've got market maturation, which is clearly happening, and it's happening way faster than I'm sure most of us have expected. And it's going to make number go up. It's going to make number go up probably a lot. So for us who, have a far earlier stake, this is pretty good. Happy days. We will see increases in attention, accessibility, so more products to compete with Grayscale, and price. Now, the trade-off is that it's going to attract stronger regulations. We're seeing this already in this proposal, this KYC, clamping down on derivatives, things like that. And we're going to see more restrictions. And it's usually the case that regulators are fairly slow. They take a long time to understand these things. There is a very, very good cohort, as I said before, of attorneys and people in this space who are incentivized to try and educate and get the best outcome. But regulators often act slow. They apply very large blanket rules that may not be very well thought out, could be a bit heavy-handed. And they generally apply these, and then it's a very slow and arduous and legal walk back to try and undo some of those rules. So I think at the end of the day, you and I obviously have no control over any of this. We're passengers in the ship. What I would just suggest to everybody is just to understand the risks and requirements in your jurisdiction. Just be careful. Make sure you keep good personal records of your, where you're trading, what you're trading. Make sure you're careful with your data. Just start thinking about your security process. Think about this ledger hack and what the implications are, because there is very likely to be many more of them, especially if regulations like this become the norm. They do create honeypots, and that data rarely ends up in one place. It ends up being sold to many. So it's not the ideal scenario, but it is the world that we have in front of us. So be aware of your jurisdictional rules and requirements. They are going to evolve over time. Overall, it's probably the only outcome that can happen. Again, we have no real say over the thing. There's enough smart people and incentivized people to push this in the right place. It's going to be a moving target, but just understand where you sit in the pie and how you can protect yourself as best as possible. So I've actually got 3 podcasts, technically two different pods, but 3 episodes that I'd recommend this week, which all are just excellent. So the first one is with the On the Brink podcast with Mustafa, who is from a Chinese miner called Bixen, and they have 2% of the BTC hash rate. And really, they go through and they distill many of the common myths. They talk about many of the different misconceptions about mining. Things like incentives, how does China's dominance play into it? Interestingly, Mustafa has some very good takes about how the West is actually going to be increasing their hash share in the near term, and also just about governance and upgrade paths. So they talk about Taproot and what the path forward looks for that, how miners actually treat it, and more or less it confirms pretty much everything that I've talked about. At least it's confirmed a lot of the things that I've been talking about for a while, which is that miners are basically the most bullish people on the network, period, because they've spent an extraordinary amount of money on capex, and they don't go into that lighthearted. And it's very encouraging to see Taproot getting 82% hash rate signaling at the moment. I suspect it's going to be fairly uncontentious, and this is good. This is really positive. It shows that there can still be evolution in the old dog. You can teach it new tricks. And to be honest, I really think this podcast in particular is one of the most insightful. If you want to understand more about the core of mining, I mean, Nick Carter's great, so he's a great host to actually have this conversation. I really think you'll get a lot of value out of this from a fundamental listen perspective. And the other one, so there's 2 pods, both from the Investors podcast with Preston Pish. There's 2 different episodes. They've started on. So the reason they've done this is they started. Preston's a Bitcoin bull, and many of his listeners are not. So they were complaining and saying Preston's banging on about Bitcoin all the time, which I get it. I sympathize. So what they've done is they've spun off. So their weekend pod will always be fundamentals based, value investing, and their Wednesday podcast will be Bitcoin centric. So the first guest was Robert Breedlove, which in terms of setting a first pod, if you were going to give someone their very first Bitcoin pod, I think this is it. It's really, really good. It kind of competes with Murad's on Pomp that happened many years ago. Really, really good. They talk about many of the misconceptions in the market, and a lot of the principles that people come in and go, oh, it's volatile. It's like, yeah, but volatility is normal. Oh, it's this. Yeah, that's normal. Right. He explains all of those points, and it's a really, really, he's a clear thinker, Robert. So worth listening to. And Jeff Booth is one that was, I think it was the 3rd episode. He's just an absolute weapon when it comes to understanding deflation and inflation. And he's got a really, really sensible take on how Bitcoin fits into the future of the world, particularly if we're in a deflationary type system, pushed by generational baby boomers retiring and just the lower spending habits of that generational side. Technology is deflationary, debt is deflationary. He talks through all of these different mechanisms, and despite all of the money printing go burr, it doesn't really matter because there's too much deflation going on. So Jeff is a really good has really good takes on this, and it's essentially something that I think is if you want to understand more about that particular deep dark rabbit hole, it's well worth listening to. So that finishes off for the news section. Just going to jump very briefly to our new Fandangly website. Oh, here we are. And just look at on the Bitcoin side and just see where we are on a few of these things. So let's go May multiple. Let's go MVRV price. These oscillators, again, really interesting volatility going on in these. And we can also look at block subsidy model, NVT, RVT. This one, which I thought was really cool. Actually, this is a new one by Permal Nino. And let's start. We've done this a few times. Let's start with our cycle chart. I'm still amazed at this, like the way that it's just following our previous attempt. Now, if you're looking at any of this, this would signal that we've kind of followed all these paths. We probably need one of these corrections. I think you would all, by looking at the chart, think we're getting close, right? We are getting close to needing some kind of correction. We also, just by going through the fundamentals before, there's clearly a whole lot, a large pool of capital that wants to buy. I think that large pool of capital, they're also not people who are going to just FOMO in. Institutions are fairly smart. They're also wealthy enough that they can move prices, right? They can shift markets around. They have traders whose job is to buy assets cheap and sell them high. So we could see a technical correction, which is actually driven by traders. So this is something that we could expect. So yes, there's buy support, but I think we are in, the way to look at this, we're in a bull market, but you must go down to go up. So the view is, even if we do keep going, there is a probability that we're going to get a relatively deep correction because people are incentivized for there to be a correction now. Because they want to buy the asset cheap, they want to scare retail, and they basically want to accumulate on their own dime. So I think that there is momentum for this thing to want to correct. The question is when and how, and what kind of price target could we expect up to that point. So if we look at our May multiple chart, so we saw before in our previous bull where we've basically come up, we've tested this middle blue line, which is our 20% line, so only 20% of history above it. We tested it multiple times, each one with a savage correction on the way up. We did break straight through it on our first attempt, and we've essentially broken through it in our second attempt. So it's kind of offered no real resistance, which is very interesting because it's basically saying that we are in that top 20% realm. It does signal that maybe there's obviously a lot of buy support, but the fact that we haven't, we're continuously testing and breaking straight through a level that otherwise has a very low probability. I mean, 20%, it's not insignificant, but it's still saying that 4/5 of history is below it. So, it would make sense that we probably are in overstretched territory, particularly this early in the bull market. I really do think we're somewhere in this mid-transition point. I think we need one of these corrections to just kind of flush everyone out. And the thing about it is that because Bitcoin is so cyclical, when we start getting the correction, everyone will come out with their charts being like, look how many times it's corrected 40%. And then everyone will expect a 40% correction, right? And then it will probably correct because people are selling and they're like, oh, well, 40%, I may as well try and sell back. And then a lot of those people will get smoked because they'll go to 38%, right? And they won't get their buy-in, which is the game that I think is most likely to be played. So at the top end of this thing, we're talking about our 10% level. So that's, above this top blue line, I mean, we've got the blow-off peak, we've got the blow-off peak, and we've got this blow-off peak, right? And then this one. The only time we've ever gone above this line, this 10%, is blow-off tops. Yep. So that price target up there is 29,000. I think many of us would not be surprised if we tagged 30,000. I think, I don't think it will get there, but I think it's probable, right? It's not improbable. But I really do think that if we get up there and it keeps going, we are technically in blow-off top territory. So, 29,000 is probably something just to be watching as a top level, but it's also starting to signal, we're halfway between these. So we're probably at, this is what, 20%. So we've probably got 15%. We're at 15% probability, which is an 85% probability of a correction. So, we're starting to get into overstretched territory. If we look at the realized price, we have much of the same. In fact, here's our 15% level. So we've basically broken straight through that. Let me just turn this off and have a look. That price is 21,000, so we're above that on the distance from the realized price. Let's just go back and see what the previous cycle looked like. We essentially found resistance on this level twice. We said before we're in this transition phase. I mean, technically, we found resistance here, we found resistance here and here, and then we've essentially gained that momentum. So look, maybe it grabs onto this thing and we get a massive repricing of the realized price. But if not, it means that there's, and again, the thing with the realized price, it depends where coins are moving, right? So if we're seeing these huge firms buying mass amounts of coin, there's going to be a lot of coins moving at whatever price they buy them at, right? Transitioning into the custodians and so on and so forth. So we could get this massive acceleration, but if we don't get that acceleration, it means that buy support may not actually be there. There's not being the withdrawals and the movement on chain. I would expect most of these coins in custodians would go into some kind of multi-sig, so they will need to be an on-chain transaction. So I do expect the realized price to interact with. So this is actually not a bad metric to be watching at this point in time because it's fundamentally tied to when people are actually buying and moving on chain. So we're in that 15% realm. Previously, we did it, in fact, correct back down below it, and then we had to find support on it twice before we just gained and mooned. But again, we really don't want to be getting up here. I mean, this is up at 40K. So I don't think we're going to get to 40K. If we do, then it's a blow off top. It's getting too high at that point, and that would actually be the same 42K. There you go. So May multiple 42, MVRV 41. If we go up to 41,000, then we're prepare for a year-long bear market. So the 14-day. This is our momentum chart. Look at this. I mean, the thing just, and what's really cool about this, so we spoke about this last week, I think. It's essentially a momentum oscillator. And as a momentum oscillator, the height of these peaks and the change, as the peaks get higher over time, it's saying that there's increasing momentum to the upside or to the downside. You can obviously see there's volatility towards the late stage of the bull, and there's less volatility through the bear market, and then the volatility really peaks back up. You can also, because it's based on the market pricing, you can do technical analysis on it. So we actually got our higher high, higher low, and then wham, away it goes. So we are technically now back into upwards momentum, which, as you can see here, here's our increasing levels. So bull market for sure, right? So it is a buy the dip type level. The question is, where do we get the buy the dip? So with the 14-day, this is something that I would actually be watching. If we get a correction from here, we might get some downside, but you can probably use this very much the same as what you have here and use this when it's trying to reverse back to the upside, very much the same. You'll be able to use this to see when your momentum's trying to kick back up to the other, in the other direction, and divergences and things like that. Block subsidy model. So this one's probably should have been covered slightly earlier, but you can see before in our previous cycle, we came up, we tested this where we said we are most likely in this zone through here. We had resistance on this line here. If we get up to, this is the 32 cap. The 32 cap is kind of, it's blow off top territory, right? 32 cap is at 35K. So again, it's obviously, it's 10,000 points above where we're at right now. I don't particularly want it to get up there because I think that would lead to a longer and more savage correction. Personally, I'd love to see just a really nice long bull flag at this point in time, and extend out for a month, 2 months of chop, or a very savage pullback would be nice as well. But I really don't want it to get up here because, as you can see, this is where we start getting into serious blow off top territory. So on the NVT and RVT ratio, this is interesting. So the NVT is the market cap divided by transaction volume, and the RVT is the realized cap. So value stored to value transacted is the RVT, and value on the spot market to value transacted is the NVT. So what's very interesting is in previous cycles, and I think this actually has to do with supply dynamics, the narrative of store of value, and how many coins are actually circulating and the amount of hodlers that are out there and so on and so forth. But if we just look at the NVT, which is these dark purple lines, low values down here is high activity, means that the chain's really, really being used a lot. And obviously the converse, at the pits of a bear market, no one cares, no one's using it, it's undervalued, right? Or it's seeing very little volume. Now, what's very interesting here is that we've got the NVT is basically staying constant, whereas the RVT is decreasing back into the bullish zone. So what that is saying is that essentially the amount of volume transacted on chain is increasing at the same rate as the spot market, which is actually bullish because it's saying that price goes up, more demand. Price goes up, more demand, right? 1-to-1, more or less. That's why we're getting this. Oh, obviously, there's oscillations, but 1-to-1. At the same time, the amount of value that is stored in the chain. So even though this is not at a low level, we've said before in the very first time I did this NVT masterclass, we were talking about, we like it to get down to this low point, and down here is basically saying there's a lot of coins moving relative to valuation. Over time, because the chain's behavior will change around, those levels may not be constant. Now, the RVT and the on-chain transaction volume are far better. So the RVT is a much better indicator to continue to behave in this oscillatory way because they're both on-chain metrics, right? The RVT is directly tethered to the transaction volume because every transaction changes the RVT or the realized price. However, for the NVT, being constant at some level, whilst price is going up, if the NVT is constant, they're 1-to-1. It means demand is increasing simultaneously with price. Bullish, right? That's a good sign. That's a really good sign. At the same time, our RVT, this is saying that the amount of value being transacted is getting higher relative to the amount that's being stored. That means that people are hodling. Old coins are not moving and being repriced. Old coins are remaining stationary. That's good for supply dynamics. Meanwhile, transaction volume is going up. Demand is going up. New coins are being bought. Old coins are staying stationary. That's what this is telling me. I actually really like this chart. And now that I've processed and understood that this sideways volume is actually saying we've kind of reached a new demand level, right? Where price and demand are 1-to-1. So this is really, really good. I'm actually quite happy to see this. That's my current interpretation of this. So overall, again, bull market, right? I think there's every reason to be bullish at this point in time. Obviously, a correction it would be nice, but we may not get it. This is kind of telling us that there is the demand on chain to support it. So in particular, I'd be looking at the MV/RV ratio and whether we get some slope in the realized cap. That would be a positive because it means that big coins, right, are being accumulated right now, put into multi-sigs and put into custodians. And the last one, this is more of an enjoyable fun fact. So this is a metric that Permal Nino and I have talked about in the past, but he's essentially developed recently, and I've stuck up on the website. Value stored per byte. So obviously the Bitcoin blockchain is 300 gigabytes or something, and you look at the market price. You look at the realized price, so the amount of value stored, what the market's pricing it at, and then the cumulative amount of value that's been transacted on chain, right? So realized in blue, market is in black, and then, you divide that. So you look at what your market cap is, and you divide it by, so how many dollars are being stored in BTC is the realized price, divided by the blockchain size, right? How many dollars per byte are being stored? Or for the market cap, the black lines, how much value does the market consider the BTC network worth per byte of data? So how data dense is the chain in terms of dollars? So there's two charts here. Let me turn off this one, and this one. So these ones here is just looking at market cap. So you can see the relationship, market cap, realized cap, cumulative blockchain size, right, in bytes, and cumulative dollars settled on chain, right? All of it's to the right-hand axis. So this is just so you can actually see the relationship between them. Let's turn these guys off. We're now going to take the ratio. So this is bytes, and we're going to take the ratio between market cap and blockchain size. And we get this massive ascending triangle, right? You can see this thing is just a big ascending triangle. So what that's basically saying, the value per byte. So this is a value of 1. That's saying $1 per byte. So for every single byte of data on the Bitcoin blockchain, $1, the market is valuing $1 of it, right? No, this one here, realized per byte. This is saying that the market is storing 48 cents per byte, right? That's how much people have actually saved in Bitcoin on a per byte basis. So the blockchain is obviously continuously growing. If no one's using it, right, things aren't being revalued, so it's actually losing value per byte. And then during bull markets, we get repricings. But this is a huge, and we now have a situation where huge institutions, so this is a huge ascending triangle saying that we're most likely going to get more value stored per byte. And this is breaking north of that ceiling price at the exact time that we're getting institutions who want to store hundreds of millions to billions of dollars showing up at the same time. It's almost poetic, right? So this is a really fun fundamental concept to think about, that the amount of value that's going to be stored per byte of data is very likely to be breaking higher from here in a big way. So, this is just a really cool metric, and I'll be really interested to see how this plays out. But from a fundamentals perspective, it seems to have a lot of credence. It's not necessarily an indicator you can use, but it's certainly an indication of performance and how BTC is performing in the global stage. Anyway, that was a relatively long one. I hope that kind of blend between fundamentals on one side and on-chain. What I will be doing in the near future is actually segmenting these two. So there'll be the traditional newsletter, and I'll be doing a market update on the on-chain side of things. I'll probably start fortnightly, and then as we get a bit more momentum, start winding it down to being weekly. So I'll be splitting these off. Most definitely the on-chain portion will be segmented and put into RSV, the Ready Set Vision portal. So there'll be a whole section on market updates for that. And the fundamentals portion, I will have a separate stream. So I'll be getting these up on RSV, so really segment them so you can go back and reference them later on. And the purpose of many of these on-chain sessions is it gives you a bit of an insight. So whilst we haven't done the class yet for any particular metric, you can still see what these metrics are doing. You can, this is really the edge that I want to give you all, is this is what I'm seeing. And then as you learn about, similar to the way that I learned to trade by listening to Doc's videos, I'm sure you've done the same, you just get bits and pieces and you learn chunks every week. And that's really the approach I want to go down. It's just those little tidbits that eventually they finally sink in and you get the aha moment. And one of those metrics matters. But in particular, I'm excited about this NVT/RVT ratio. This is happy days. I like this. So as always, you can always grab me in the chat room if you've got any questions. And if you have any feedback on the Check on Chain website, if you have any feedback on the masterclass, I'm all ears. I'm certainly looking to improve and understand what works and what doesn't. There's a lot of stuff in the pipeline coming into Christmas. So look forward to rolling all of that out. Until then, cheers.